Gold, 12%. Silver, 36%. The real reason behind the drop: gold, $5,608, the highest price in recorded history. 24 hours later, gone. 12% erased. Silver, 121 was 78, a price the world had never seen before. 24 hours later, 36% vanished. Over $1 billion in leveraged positions wiped out in a single afternoon. Every major outlet called it historic, but not one of them told you why it actually happened. Until now. Welcome back to AO and Ag. And if this is the first time someone has brought you here, then perhaps it was meant to be today. Now, before anything else, a small request. Not for this channel, not for any algorithm, for yourself. There is a subscribe button just below this video. It costs nothing. It takes 1 second. But what it does is this: the next time the market moves, the next time someone tries to sell you panic disguised as analysis, you will hear the truth first. Think of it as keeping the right newspaper on your desk, the one you trust, the one that has never lied to you. That is all this is. Now, tell me something in the comments. Where are you watching from today? Lahore, Karachi, Mumbai, Dubai, London, Toronto, New York? Let me know. Because what happened on January 30th does not respect borders. It affects every single person holding gold or silver anywhere in the world. Now, let us begin. To understand what happened on Friday, January 30th, 2026, one must first understand what happened the day before. Thursday, January 29th, 2026, was a day of celebration. Gold touched $508 per ounce, an all-time high, a number that most analysts, most banks, most institutions had said would not arrive until the end of the year. It arrived in January. And silver rewrote history entirely. It touched $121.78 per ounce, the highest price for silver in the entire modern era, higher than 2011, higher than 1980, higher than any number ever recorded on any exchange anywhere in the world. On that Thursday evening, traders celebrated. Social media exploded. Content creators uploaded victory videos. Comments sections filled with diamond hand emojis and promises of $200 silver by March. The mood was euphoric. The mood was dangerous. Because what most of those traders did not know, what most of those content creators did not tell their audiences, was that behind the celebration, the market was already breaking. Not breaking in the way that makes headlines. Not breaking in the way that triggers alerts on a phone screen. Breaking quietly. Breaking structurally. Breaking in the places where only the most experienced eyes were looking. The relative strength index on gold had reached 90. Bloomberg published this number. It was available on every charting platform in the world. And for anyone who understood what it meant, it was a fire alarm ringing in an empty building. An RSI of 70 means an asset is overbought. An RSI of 80 means experienced traders begin reducing their exposure. An RSI of 90 on gold had occurred only a handful of times in 50 years. And every single time, without exception, a violent correction followed. But on Thursday night, no one wanted to hear that. Then came Friday, January 30th, 2026. The morning began with news. President Donald Trump officially announced the nomination of Kevin Warsh as the next chair of the Federal Reserve. He posted it on Truth Social. He said he had no doubt that Warsh would be one of the greatest Fed chairmen in history. The market did not wait for analysis. The market did not wait for debate. The market reacted. Within minutes, the US dollar surged. Treasury yields spiked. And gold, which had been floating on the expectation of aggressive rate cuts, lost the single most important pillar holding it up. Gold did not dip. Gold did not correct. Gold collapsed. From $5,608, it fell through $5,400, then through $50,200, then through $5,000. By the time New York afternoon trading was underway, gold had fallen below $40,800. Bloomberg reported an intraday decline exceeding 12%, the largest single-day drop for gold since the early 1980s. And silver was something else entirely. From that record, 121, power 78. Silver plunged to $74.60 at its lowest point, an intraday decline of more than 36%. Not since the Hunt brothers' collapse in 1980 had the silver market witnessed anything remotely comparable. The ProShares Ultra Silver ETF crashed nearly 60% in a single session. The iShares Silver Trust fell 29%. Both their worst days ever recorded. By the time the dust settled on Friday's close, gold futures had dropped approximately 11.4%. Silver futures had fallen roughly 31%. More than $1 billion in leveraged positions had been liquidated, not over weeks, not over days, in hours. Traders who had been celebrating on Thursday night were staring at margin calls on Friday afternoon. Accounts that had been profitable at sunrise were empty by sunset, and across the world, from Lahore to London, from Mumbai to Manhattan, one question echoed louder than any other. What happened? Was it manipulation? Was it conspiracy? Was it the banks? Was it the algorithms? Was it something darker, something hidden, something that powerful people did not want the public to understand? The answer is both simpler and more important than any conspiracy theory. And it begins with a name most people had never heard before, Thursday, Kevin Warsh. That story unfolds next. Calm, measured, like an investigator opening a case file. There is a pattern that repeats itself every time a market crashes. First comes the shock. Then comes the anger. Then come the theories. Within hours of Friday's collapse, the internet was flooded with explanations. Banks crashed the price, market makers stole positions, hedge funds conspired against retail investors. JP Morgan engineered the entire thing from a dark room somewhere in Manhattan. These stories are powerful. They are emotional. They are satisfying. And for most people, they are the only explanation they will ever hear. But there is a problem. They are incomplete. Not entirely wrong, not entirely right, but dangerously incomplete. Because what actually happened on January 30th, 2026, was not one event. It was 4 events, arriving at the same door, at the same moment, with the same result, and each one was documented. Each one was public. Each one was available to anyone willing to look beyond the YouTube thumbnail. The first force, a name called Warsh, investigative tone. Kevin Warsh is not a name that most retail investors recognized before Friday morning, but inside the world of central banking, inside the rooms where monetary policy is debated, Kevin Warsh had been known for nearly 2 decades. He served on the Federal Reserve Board from 2006 to 2011, during some of the most turbulent years in modern financial history. And during those years, he built a reputation, not as a moderate, not as a dove, as a hawk. He criticized quantitative easing publicly. He called the Federal Reserve's balance sheet bloated. He argued for tighter monetary policy, even in the aftermath of the 2008 financial crisis, when most of his colleagues were pushing for the opposite. Bloomberg reported the nomination. CNBC confirmed it. NBC News covered it. Al Jazeera published it. The Wall Street Journal ran analysis within the hour. Now, why does a single nomination matter to gold and silver? Because gold pays no interest. Silver pays no dividend. They sit in a vault, or in a warehouse, or in an ETF, and they earn nothing. When interest rates are expected to fall, investors accept that. They hold metals because they expect the price to rise faster than the interest they are giving up. But when a hawkish Fed chair is nominated, the calculation changes instantly. Interest rates may stay higher for longer. Bonds suddenly become more attractive. Treasury bills start paying real returns. And the money that had been flowing into gold and silver begins flowing out. On Friday morning, the US dollar surged on the Warsh announcement. Bloomberg reported that commodity currencies, including the Australian dollar and the Swedish krona, sold off sharply. Treasury yields jumped, and every leveraged gold and silver position in the world suddenly became more expensive to hold. The Warsh nomination did not cause the crash alone, but it lit the match in a room that was already filled with gasoline. The second force, the parabolic trap, slower, teaching tone. There is a word that experienced traders fear more than any other, parabolic. It means an asset is no longer rising in a healthy way. It is rising vertically, exponentially, in a curve that mathematics itself says cannot sustain. Gold had risen approximately 27% in January alone, from around $430 at the start of the month to $5,608 at Thursday's peak. In 30 days, that is not a rally. That is not momentum. That is a parabolic advance. And parabolic advances have a 100% historical failure rate. Not 90%, not 95%, 100%. Every parabolic move in the history of financial markets has ended in a sharp reversal. Every single one. Silver had moved even faster, even steeper, even more dangerously, and the technical evidence was screaming. Gold's relative strength index hit 90. Bloomberg published this. TradingView displayed it. MetaTrader showed it. Every professional charting platform in the world had the same number on the screen. An RSI above 70 means overbought. Above 80 means dangerously overbought. At 90, there is no debate. There is no discussion. The signal is as clear as a red traffic light on an empty highway at midnight. Trading Economics documented it directly. Gold slid more than 7% on profit-taking, but remained on track for a monthly gain exceeding 13%. Its strongest monthly performance since the 1980s. Large institutions saw the same data. Hedge funds saw it. Pension funds saw it, and they did what professionals always do when an asset goes parabolic with an RSI of 90. They sold. Not because of conspiracy, not because of manipulation, because that is what portfolio management looks like. The third force, the margin machine. Tone shifts, more technical, more precise. This is where the crash transformed from a sell-off into a catastrophe. On January 13th, 2026, Bloomberg reported that CME Group, the largest derivatives exchange in the world, quietly changed how it calculates margin requirements for precious metals futures. Previously, margins were fixed dollar amounts. The trader knew exactly how much collateral was needed per contract. But CME shifted to a percentage-based system. This meant, as gold and silver prices climbed higher, the margin required to hold each contract automatically increased with them. Most retail traders did not notice this change. Most content creators did not mention it, but it was public. It was published. And it was a ticking time bomb. Then came Friday's crash, and the bomb detonated. As gold fell from $5,608 and silver fell from $121, the CME acted again. Bloomberg confirmed on January 31st that CME raised margins further. Gold margins would now be 8% of contract value, up from 6%. The heightened risk profile increased to 8.8% from 6.6%. In simple terms, a trader holding silver futures who had deposited enough collateral on Thursday morning suddenly did not have enough on Friday afternoon. The broker did not call, the broker did not negotiate, the broker liquidated, automatically, instantly, at whatever price the market would give. Finance magnates described what followed as a capitulation event. Estimates suggested more than $1 billion in leveraged positions were forcibly liquidated during Friday's session alone. This is not new. In 1980, margin hikes helped end gold's rally above $850. In 2011, the infamous Silver Sunday Night Massacre was triggered by the same mechanism. In late December 2025, CME raised silver margins by 30%, and silver dropped 8.7% in a single day. The pattern is documented. The pattern is public. The pattern repeats. Every single time precious metals rise too far, too fast. The fourth force, the options trap, final gear, connecting the pieces. The fourth force is the one almost nobody talked about. Goldman Sachs published a note, cited directly by Bloomberg, explaining that a record wave of call option purchases had been mechanically reinforcing upward price momentum. What does that mean in plain language? When a trader buys a call option on gold or silver, the institution that sells that option must hedge its risk. It does this by buying the actual metal or the futures contract. So every call option purchased created additional buying pressure, not because of real demand, not because of genuine investment, because of mechanical hedging. And this meant the rally was being amplified artificially. The higher gold and silver went, the more call options were purchased, the more hedging was required, and the higher the price climbed. A feedback loop, a machine feeding itself. But feedback loops work in both directions. When the Warsh nomination hit and profit-taking began and prices started falling, those same institutions that had been buying to hedge now needed to sell. The hedges were unwinding, the machine reversed, and instead of pushing prices up, it was now pushing prices down with the same mechanical force. A strategist at Overseas Chinese Banking Corp told Bloomberg directly, this was a market that was primed for extreme moves in either direction. The Warsh nomination was simply the excuse the market needed to unwind positions that had become unsustainable. Four forces, a hawkish Fed nomination, a parabolic rally begging for correction, margin hikes that turned a sell-off into forced liquidation, and options mechanics that amplified every move in both directions. Together, they do not just explain the crash, they explain it completely. No shadowy bankers required, no secret rooms, no conspiracy, just mechanics, just mathematics, just market structure. Doing exactly what market structure has always done. But here's the question that matters more than any of this. If all four of these forces were public, if all four were documented, if all four were available to anyone with an internet connection, then why did so few people see it coming? That question is answered in part 3. Long pause, then quiet, almost disappointed. There's a difference between a crash that no one could have predicted and a crash that no one chose to see. Friday, January 30th, 2026, was not the first kind. It was the second. Every warning was there. Every signal was flashing. Every piece of data that could have protected a trader, an investor, a family putting savings into silver, was sitting in plain sight. Published, free, accessible to anyone with a screen and 5 minutes of patience. And yet, almost no one talked about it. Not because the data was hidden, not because powerful people buried it, not because algorithms suppressed it. Because the truth does not get clicks. The truth does not go viral. The truth does not make a good thumbnail. Conspiracy does. The first warning, the number that screamed, teaching tone, patient, precise. Let us begin with the simplest warning of all. A number, one single number, available on every charting platform in the world. Free on TradingView, free on MetaTrader, free on every brokerage terminal from New York to Karachi. The Relative Strength Index, gold's RSI, in the final days before the crash, had reached 90. Now, for anyone unfamiliar with this indicator, RSI measures how fast and how far an asset has risen relative to its recent history. It runs on a scale from 0 to 100. A reading of 50 is neutral. A reading of 70 means the asset is overbought, meaning it has risen too far, too fast, and a pullback is statistically likely. A reading of 80 is a serious warning. Professional traders at every major institution in the world begin reducing exposure when RSI crosses 80. A reading of 90 on gold is not a warning. It is a siren. Bloomberg published this number. It was not buried in a footnote. It was not hidden behind a paywall. It was reported openly, clearly, directly. Gold's RSI had reached the highest level for the metal in decades. In the last 50 years, gold's RSI has reached 90 only a handful of times. And every single time, without one exception, a violent correction followed. Not a small dip, not a minor pullback. A violent, sudden correction. This information was free, this information was public, and this information was ignored by nearly every content creator who uploaded a video in the week before the crash. Instead, those creators told their audiences to hold, to buy more, to trust the process, to believe in $200 silver by summer. They had the RSI on their screens. They chose not to show it. The audience trusted them. The audience paid the price. The second warning, the ratio that broke, slower, more analytical. There is a relationship between gold and silver that has existed for centuries. It is called the gold-silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. When this ratio is high, silver is cheap relative to gold. When this ratio falls sharply, it means silver is rising much faster than gold. It means speculation is entering the silver market at a pace that exceeds fundamental demand. In the weeks before January 30th, this ratio had collapsed to levels not seen since the late 1970s. A Bloomberg macro strategist observed this directly. He wrote that the rise in the silver to gold ratio had been nearly as large as the move seen in the late 1970s. And he noted that Friday's dramatic reversal suggested this may mark what he called a rejection point. For anyone who knows the history of the late 1970s, that comparison alone should have been enough to pause. In the late 1970s, silver surged from under $6 to nearly $50 per ounce. The gold-silver ratio collapsed in almost identical fashion. Speculation reached fever pitch. The Hunt brothers attempted to corner the silver market. And then, in January 1980, silver crashed more than 50% in a matter of weeks. The pattern was not similar to 2026. The pattern was nearly identical. The same ratio compression, the same speculative frenzy, the same vertical price movement, and ultimately, the same violent reversal. This comparison was publicly available. This history is not classified. It is on Wikipedia. It is in every commodities textbook ever written. But history does not generate excitement. History does not make someone feel like they are part of a revolution. So history was ignored. The third warning. The leverage that built a house of cards, more urgent, building intensity. The third warning was not a chart. It was not a ratio. It was a structure of leverage so extreme, so concentrated, so fragile, that it needed only the smallest push to collapse entirely. Goldman Sachs published a note, reported directly by Bloomberg, documenting that a record wave of call option purchases had flooded the gold and silver markets. These were not small positions. These were not cautious bets. These were massive, leveraged, one-directional wagers that gold and silver would continue rising without interruption. And the mechanics of those options were making the problem worse. Every call option purchased forced the seller of that option to hedge by buying more gold or silver. This created artificial buying pressure. It pushed prices higher, which encouraged more call option purchases, which required more hedging, which pushed prices higher still. A feedback loop, a self-reinforcing cycle. A machine that was feeding itself with no fundamental demand underneath it. The Commitment of Traders report, published weekly by the CFTC, showed the same picture. Long positions were at record levels. Short positions were minimal. The market was leaning entirely in one direction. And there is a rule in markets that has never been broken. When everyone is on one side of the trade, the other side becomes inevitable. U.S. government data released on Friday confirmed the extent of the damage. Hedge funds and large speculators had slashed their net long positions in silver by 36% to just 7,294 contracts, the lowest level in 23 months. The unwinding was not gradual, it was violent. This data was public. This data was free, and this data told a story that contradicted everything the loudest voices on the internet were saying. The fourth warning, the history that repeats, quieter now, almost reflective. The final warning required nothing more than memory. In 1980, gold reached $850 per ounce. Adjusted for inflation, it remains one of the highest prices gold has ever achieved. The rally was driven by inflation fears, geopolitical tension, and a wave of speculative buying that overwhelmed the market. Then came the margin hikes. Then came the liquidations. Then came a crash that erased more than 60% of gold's value. In 2011, silver reached $50 per ounce. The rally was driven by currency debasement fears, quantitative easing, and a massive buildup of leveraged long positions. Then came the margin hikes. 5 margin increases in 8 days by the CME. Silver fell from $50 to $26 in weeks. Traders called it the Sunday Night Massacre. In late December 2025, CME raised silver margins by 30%. Silver dropped 8.7% in a single day. A rehearsal, a preview, a warning shot. And then, January 2026, the same ingredients, the same sequence, the same outcome. Rapid rise, extreme optimism, over-leveraged positions, margin hikes, collapse. Finance magnates published this comparison openly. The parallels were not subtle, they were not debatable, they were exact. And yet, how many content creators showed their audiences this history? How many said, this pattern has happened before, and every time it ended the same way? Almost none. Because history is boring, history is cautious. History tells people what they do not want to hear. And on the internet, the creator who tells people what they want to hear will always have more subscribers than the one who tells them the truth. Pause, long breath. 4 warnings, all public, all free, all ignored. An RSI of 90 that screamed overbought. A gold-silver ratio that mirrored the late 1970s. A leverage structure so fragile that Goldman Sachs documented its danger in writing. And a historical pattern so precise that it is repeated in 1980, in 2011, in December 2025, and now in January 2026. The crash was not unpredictable. The crash was simply unprofitable to predict. And that distinction is the most important lesson any investor will ever learn. But knowing what went wrong is only half the equation. The other half, the half that actually matters now, is knowing what comes next. That is part 4. Calm, steady, the tone of someone sitting across a desk from a serious investor. Every crash creates 2 types of people. The first type panics. They sell everything. They swear off the market. They tell themselves they were foolish to believe. They walk away, and they do not come back until prices are high again. Then they buy at the top again. The second type pauses. They study. They examine what broke, what held, and what the data says about what comes next. They do not react to fear. They do not react to greed. They react to evidence. Part 4 of this story is written for the second type because the crash of January 30th, 2026 did not destroy the case for gold and silver. It tested it. And understanding the difference between destruction and testing is what separates the investor who builds wealth over decades from the one who chases thumbnails for weeks. The case that remains, analytical, grounded, every claim sourced. Let us begin with what has not changed. J.P. Morgan, one of the largest financial institutions on earth, published research projecting that gold demand from central banks and institutional investors would average approximately 585 tons per quarter throughout 2026. Their base case price target for gold stands at $5,500 per ounce by the fourth quarter of 2026, rising toward $5,400 per ounce by the end of 2027. They did not withdraw this forecast after Friday. They did not revise it downward. The structural thesis, in their assessment, remains intact. And their upside scenario, the scenario that assumes increased household allocation to gold, projects prices reaching $6,000 per ounce or higher. Central banks around the world have been accumulating gold at a pace exceeding 1,000 tons per year in recent years. China, India, Turkey, Poland, Singapore. These are not speculative traders buying call options at midnight. These are sovereign institutions, building reserves, reducing dependence on the US dollar, preparing for a world where the global monetary order looks very different from the one that existed 10 years ago. That behavior did not stop on Friday. That behavior is accelerating. Silver's fundamentals tell a similar story. The silver market has been running a structural supply deficit for 5 consecutive years. Demand from solar panel manufacturing, electric vehicles, semiconductors, and artificial intelligence infrastructure continues to grow. Every solar panel requires approximately 20 grams of silver. The solar industry alone now consumes nearly 30% of total global silver demand. Electric vehicles use between 25 and 50 grams each. HSBC projects this structural deficit to widen further in 2026, which suggests that the supply-demand imbalance supporting silver prices has not been resolved by a single day of selling, and here is the number that puts Friday into perspective. Even after the worst single-day crash in decades, gold ended January 2026 with a gain of approximately 13%. Silver ended the month up roughly 19%. These remain the strongest monthly returns for gold since the 1980s. The crash was real. The crash was severe. But the crash occurred within the context of a bull market that remains, by every structural measure, intact. The risks that also remain. Tone shifts slightly. Honest, direct. But honesty requires both sides. Bloomberg's senior commodity strategist Mike McGlone wrote on Friday that the higher metals rise, the more likely 2026 will mark enduring price peaks, notably for silver. If history is any guide, J.P. Morgan analysts cautioned that silver prices had already, in their words, significantly overshot their forecasted averages. And the nomination of Kevin Warsh introduces a variable that the market has not yet fully priced. If Warsh pursues tighter monetary policy, if interest rates remain elevated longer than expected, if the dollar continues to strengthen, then the headwinds facing gold and silver could persist for months, not days. Former J.P. Morgan chief strategist Marko Kolanovic went further. He suggested silver could trade at roughly half its current price later in 2026. His reasoning draws directly from the 1970s parallel, where gold surged from $40 to $200, crashed 50%, shook out every weak hand in the market, and then rallied to $800. His argument is not that silver is finished. His argument is that the correction may not be over. An honest analysis presents both possibilities, the bull case and the bear case. The opportunity and the risk, any analysis that shows only one side, is not analysis, it is salesmanship. The strategic framework, warmer now, practical, like advice given to a younger family member. So, what does a serious investor do with all of this information? Not a gambler, not a speculator, not someone looking for the next trade to post on social media. A serious investor, someone building wealth that will last, not just until next Friday, but for the next generation. Guideline 1. Position. Size is survival. If more than 15 to 20% of any investor's total portfolio sits in precious metals, that investor is not diversified. That investor is concentrated. And concentration, in a market capable of dropping 36% in a single day, is not conviction. It is exposure. Friday proved this in the most brutal way possible. Traders who had allocated responsibly, who held gold and silver as one part of a broader portfolio, experienced a painful day. Traders who had put everything into leveraged silver positions experienced financial devastation. Position sizing is not glamorous. It does not make for exciting content, but it is the single most important decision any investor makes, and it is the one least discussed by the loudest voices online. Guideline 2. Know the levels. Gold's key psychological support sits at $5,000 per ounce. This level was breached multiple times on Friday. Below that, the $4,900 area represents the current stabilization zone. JM Bullion reports the spot price near $4,903 as of Saturday, with the market treating $5,000 as a pivotal battleground. For silver, the $85 to $100 range is now the consolidation zone. A strategist at Zaner Metals noted that the break below $100 could represent, in his words, an opportunity, particularly near the 20-day moving average around 93. But he warned clearly that elevated volatility is likely to persist. These are not predictions, these are reference points. An investor who knows these levels can make decisions based on evidence. An investor who does not is trading blind. Guideline 3. Separate signal from noise. This guideline is not about gold. It is not about silver. It is about every piece of financial content consumed by every investor, everywhere. When watching any analysis, including this one, a serious investor asks 4 questions. First, does the creator use emotional language? Words like legend, diamond hands, we showed them. These are not analysis. These are engagement tools. They are designed to create tribal loyalty, and tribes hold positions, even when the data says to reduce. Second, does the creator build enemies? The banks fear you. Wall Street is trying to steal your wealth. When a creator constructs an adversary, he is not educating, he is recruiting. Soldiers hold their ground, investors manage their risk. Third, does the creator use artificial urgency? Monday will be the biggest gap up in history. This is your last chance to buy. This is not information. This is pressure. This is the fear of missing out, weaponized and packaged as analysis. Fourth, and most critically, does the creator hide the bearish data? Every honest analysis presents both sides. If a creator only shows the bullish case, only shows the reasons to buy, only shows the numbers that support his narrative, then he is not helping his audience. He is selling them. His product is their attention, and their attention is worth more to him than their financial safety. Guideline 4. Verify before you trust. This is the simplest guideline, and the one most often ignored. Before acting on any claim, any prediction, any analysis, verify it. Check the source. Look up the number. Read the original report. Not the summary, not the tweet, not the thumbnail. The original. Bloomberg is free to access in limited form. Trading economics is free. The CFTC Commitment of Traders report is free. CME margin announcements are free. Central bank gold purchase data is free. The information that could have protected investors before Friday's crash was not expensive. It was not hidden. It was not locked behind a vault door. It was free. It simply required the discipline to look. Long pause. The pace slows to its final rhythm. The crash of January 30th, 2026 will be remembered. It will be studied. It will be referenced in textbooks and trading courses for years to come. But what should be remembered most is not the crash itself. It is the fact that every warning was available, every signal was public, every piece of data that mattered was sitting in plain sight, waiting for someone to read it. The market did not hide the danger. The market announced it. The only question was whether anyone was listening.